All right, so we're diving into the stock market today. And wow, you weren't kidding. This video you sent over, it's
yeah.
really in-depth. I'm already learning a ton. And since you mentioned an investment meeting coming up, I'm guessing we're going for like a deep understanding, not just, stock market basics, right?
Absolutely. Not just the basics. We're going to get you comfortable really navigating the market.
Okay, I'm up for the challenge.
Great.
I get the basic idea of stocks. You own a little piece of a company.
Right.
But then this video dives into market capitalization. And I have to admit, that's where things get a little fuzzy for me.
It's a tricky one. A lot of people stumble on market cap, but it's super important. See, share price is just the cost of one slice of the pie, but market capitalization tells you the value of the entire pie, the whole company.
So let me see if I get this. Two companies could have the same share price, but if one has a way bigger market cap, that means it's actually a much bigger, more valuable company.
Exactly. You got it. Understanding market cap helps you compare companies apples to apples. That seemingly cheap stock might not be such a bargain if it's just a tiny slice of a very small pie.
That's a great way to put it. I like that analogy.
Good.
So why would a company even want to share ownership? Like, why issue stock in the first place?
Good question. It seems counterintuitive, right?
I like giving up control.
We got to think about it from the company's perspective. They want to grow, expand, launch new products, and issuing stock is like a massive crowdfunding campaign. It's how they raise money capital to fund those ambitious ventures.
So instead of going to a bank for a loan, they're saying, hey, invest in us and be a part of our success.
Exactly. And that initial public offering, that IPO, that's their big debut, they go public. Offer those shares to the world for the first time.
Makes sense. So we've got what stocks or why companies issue them.
Right.
Now let's talk types of stock.
Yeah.
Common stock and preferred stock.
Right.
I'll be honest, those always sounded kind of intimidating.
Yeah, they can seem that way. But actually, they're fairly straightforward. Most people, when they think of stock, they think of common stock. Right. You own a piece of the company and you get voting rights. You have a say in company decisions.
So potentially, I could influence a company if I own enough stock.
Potentially. Yeah. That's the idea.
That's pretty cool. What about preferred stock? Why is it preferred?
Preferred stock, think of it like a VIP pass. You don't get voting rights, so less and company matters. But you get priority when it comes to dividends. Those are the payments a company might give to shareholders. And if the company hits hard times, preferred stockholders are higher on the list to get paid out.
So it's less control, but potentially more financial security.
Interesting.
Right. It's a trade-off.
Makes sense to me.
Yeah.
Now, the video broke stocks down by market cap, large cap, mid cap, small cap, like sorting companies by size, right?
Exactly. Large cap stocks, those are the titans.
Okay.
Market cap of $10 billion or more. Think like Apple, Johnson & Johnson, the big names.
Often they're seen as more stable, but they might not have that explosive growth potential as smaller companies.
That makes sense.
Yeah.
Then there are the mid-cap stocks, the in-betweeners.
Yeah.
What's interesting about them?
Mid-caps occupy that sweet spot, $2 to $10 billion market cap.
Okay.
They've proven themselves, but they still have room to grow. Often a good balance of stability and potential.
Okay. And last, we've got the small-cap stocks.
Yeah.
The startups, the up-and-comers.
Exactly. High risk, high reward. They're the venture capitalists of the stock market. Market caps under $2 billion, often in those emerging industries or with really disruptive technologies.
So understanding these market cap categories gives you a quick idea of a company's size and potential risks and rewards.
Yeah, exactly.
Okay, but wait, there's more. The video also talks about growth, income, and value stocks.
Right. We're just getting started.
These categories go beyond size and look at a company's whole investment approach. So growth stocks first. The video uses Amazon and Tesla as examples, and they're both known for rapid expansion and just constant innovation.
Growth stocks are all about, growth.
Makes sense.
They take their profits and reinvest them right back into the business, focusing on expanding their market, developing new products. Not really focused on paying dividends. They want to grow.
So growth stocks for someone comfortable with risk, looking for those potentially high returns down the road.
That's it.
What about income stocks? The video mentioned Verizon and utility companies, those steady, reliable companies.
Income stocks, think of them as the bond-like investments of the stock market. They're companies that prioritize those consistent dividend payouts, appealing to investors who want that steady stream of passive income.
So income stocks are more slow and steady, perfect for someone who maybe relies on their investments for regular income.
Exactly.
And finally, we have value stocks, the hidden gems undervalued by the market. This is intriguing.
Value stocks, they're the bargain hunters. Their share price is considered lower than their true worth, maybe because of like a temporary setback or just the market overreacting.
So the strategy is find these undervalued companies, invest, and then when the market catches up to their true value, you benefit.
Exactly. It's about finding those diamonds in the rough.
Okay, so we've got these three main investment styles, growth, income, value, and they each cater to a different type of investor.
Right.
But before we move on, the video briefly mentioned stock sectors.
Yes, stock sectors, they're like categories grouping companies with similar business activities.
Oh.
A way to organize the market. We've got energy, technology, healthcare, financials, real estate, you name it.
So instead of looking at individual companies, you can analyze entire sectors, see how those industries are performing, and maybe spot opportunities.
Right. Each sector behaves differently. You know, if interest rates rise, the financial sector might be impacted differently than, say, the technology sector.
So understanding these sectors helps investors make smarter decisions and maybe diversify their portfolios. This is a lot to take in. We've covered so much ground already, but I have a feeling this is just the beginning, right?
Just getting started. We've laid the groundwork. Now we're going to dive into how the market actually works, how stocks are traded, what makes those prices go up and down, and all those key players involved.
Sounds exciting.
I'm ready.
Buckle up. It's going to be a wild ride.
All right, let's go.
So we've got our stock market vocabulary down. We're starting to get a feel for the different players in the game, but now we're curious about the actual playing field. Where does all this buying and selling happen?
Well, picture a bustling marketplace, but instead of, vendors selling produce, you've got buyers and sellers from around the world trading shares of companies. These virtual marketplaces, they're called stock exchanges.
Oh, so it's like an online auction house for stocks. I can just imagine like the frantic bidding and the flashing numbers on the screen.
It's definitely fast-paced, that's for sure. Some of the most famous exchanges. You've got the New York Stock Exchange, that's the iconic one on Wall Street. The NASDAQ, known for its tech-heavy listings, and the London Stock Exchange, a major player globally.
Okay, so these exchanges where the action is, but I can't just walk in and start trading, right?
Yeah.
I need like a special access pass or something.
You need a guide in this bustling marketplace, a licensed broker. They're like the seasoned navigators. They have access to the exchanges and can execute trades on your behalf. Think of them as your stock market concierge.
Okay, that makes sense. And with all these online brokerages these days, it seems like anyone with an internet connection can be an investor.
That's right. The barriers to entry have definitely lowered, making the market much more accessible to individual investors. Now, you mentioned those flashing numbers, those price fluctuations, they can be a little dizzying.
Yeah, I've seen those stock tickers on TV prices constantly moving up and down. It's like a financial roller coaster.
Yeah.
What actually drives those price movements? Is there like a secret formula or something?
Oh, if only it were that simple stock prices are driven by the same fundamental forces that govern any market supply and demand. When more people want to buy a stock than sell it, the price goes up, and when more people want to sell than buy, the price goes down.
Okay, that makes sense in theory, but what actually influences all those buyers and sellers to make their moves?
Well, it's a fascinating mix of factors. We've already talked about market risk, those big picture economic events that can impact, overall investor sentiment. But there are also company-specific factors like earnings reports, new product launches, even, shifts in leadership. Remember, the stock market is all about future expectations. So any news that might impact those expectations can trigger a wave of buying or selling.
So if a company announces amazing earnings, investors get excited, the rush to buy the stock, and the price goes up. But if there's bad news, like a product recall or missed earnings targets, everyone heads for the exits and the price drops.
Exactly. It's like a constant dance between perception and reality, investors trying to predict the future, based on the information they have.
This makes me think back to our talk about risk. Even if a company has solid fundamentals, unexpected events, market crashes, pandemics, who knows what could still impact its stock price? It's like the market has a mind of its own.
You're right. It highlights that inherent uncertainty in the market and why diversifying your investments to spread that risk is so important now to help navigate this complex landscape. Investors often rely on benchmarks. They're called indices.
Right. The video mentioned those, the S&P 500, the Dow Jones. I hear those names all the time. What exactly do they represent?
Think of indices as as like representative samples of the market. They track the performance of a group of stocks, giving you a snapshot of how a particular market or sector is doing. The S&P 500, for example, tracks 500 of the largest publicly traded U.S. companies, so it gives you a pretty broad view of the overall market.
Okay, so instead of trying to track hundreds of individual stocks, I can just look at an index like the S&P 500 and get a general sense of how things are going. That's helpful.
Yeah. Exactly. Indices are very powerful tools for gauging market trends and comparing your own portfolio's performance against, that benchmark.
Yeah, I could see how that would be helpful if my investments are consistently doing worse than a major index. Maybe it's time to rethink my strategy.
Right, and that's why understanding these market dynamics is crucial. It's not just about picking stocks, it's about understanding those forces that shape the market and making informed decisions based on your own goals and your own risk tolerance.
So we've got these stock exchanges, our virtual marketplaces, brokers, facilitating the trades and indices, tracking the performance of different parts of the market. It's a fascinatingly complex ecosystem.
And we're only scratching the surface. There are layers upon layers of regulations and financial instruments and investment strategies we could dive into. But before we get lost in the weeds, let's shift gears and talk about how to actually evaluate those individual stocks we keep discussing.
Sounds good to me. We've got the lay of the land now. I'm ready to learn how to spot those winning investments. Right, so we've explored the market's mechanics, those exchanges bustling with activity, the role of brokers, and the insights we get from indices. But now let's zoom in. How do we actually evaluate individual stocks? This video you shared talks about analyzing company fundamentals, and I'm ready to put on my analyst hat.
Excellent. It's like being a detective, piecing together clues to understand a company's financial health and growth potential. We're going beyond the hype and digging into the nitty-gritty.
Okay, love it. Where do we even begin? What are the key metrics we need to pay attention to?
Well, one of the first things to look at is revenue. It's at the top of the income statement, showing how much money a company's bringing in through its operations. It gives you a sense of, its size and scale.
Okay, revenue, the money coming in the door. A company with growing revenue, that's generally a good sign, right? But revenue alone doesn't tell the whole story, does it?
Yeah, you got it. We also need to know how much of that revenue turns into actual profit. That's where earnings come in. It's the bottom line, the net income after all the expenses are paid.
Earnings, the money the company keeps after paying the bills. I'm starting to see how these financial statements can reveal a lot about a company's performance.
Absolutely. Strong and consistent earnings growth. That's what investors love to see. It shows a company's ability to generate profits and potentially reward its shareholders. But we don't stop there. We also got to look at debt levels.
Debt. That word always makes me a little nervous.
Yeah.
Isn't some debt normal for businesses, though?
You're right. Some debt can be healthy. It allows companies to invest in growth opportunities. But too much debt can be a red flag. It weighs the company down, limits its flexibility, and makes it more vulnerable during tough economic times.
So how can we tell if a company's debt is manageable or if it's like drowning in loans?
One helpful ratio is the debt-to-equity ratio. It compares a company's total debt to its shareholder equity, so it gives you a sense of its financial leverage. A high debt-to-equity ratio could be a warning sign.
I see. It's like checking a company's credit score before you go into business with them. Okay, so healthy revenue, solid earnings, manageable debt. Those are the financial fundamentals. But the video also mentions qualitative factors.
Right. That's where things get really interesting. Numbers are important, but we can't ignore things like the management team, the competition, and the overall industry trends.
Right. A company could have amazing financials, but if it's in a shrinking industry or facing tough competition, that could hurt its future.
Exactly. It's all about connecting the dots, seeing the big picture. You could have a company with great numbers, but if its industry is being disrupted or its management team is shaky, those are red flags.
So this is where the art of investing comes in, right?
Yeah.
Using our judgment and intuition.
You got it. It's about understanding the story behind the numbers. What's the company's strategy? What are its advantages? Does it have a clear vision for the future?
So we're not just crunching numbers. We're also trying to understand the company's narrative, its place in the world, and its potential for success down the line. This is feeling a lot less intimidating and a lot more interesting.
That's the spirit. And remember, there are tons of resources out there to help you research companies. Annual reports, financial news websites, professional research platforms, they can all provide valuable insights.
Right. And the video even mentions just observing the world around us, paying attention to the products we use, the companies that are doing well, the trends shaping the future.
Exactly. It's like being a trend spotter, constantly gathering clues and connecting the dots. The more you understand the world of business and finance, the better your investment decisions will be.
Wow. This deep dive has been incredible. We demystified the stock market, explored how it works, and now we have the tools to evaluate investment opportunities. I feel a lot more prepared for that investment meeting now.
I'm glad to hear that. Remember, knowledge is power in the stock market. The more you understand, the better equipped you'll be to navigate it all.
And I have a feeling this is just the beginning of my stock market journey. There's always more to learn.
Absolutely. The market is constantly evolving, so you have to keep learning and adapting too. Stay curious, and remember, investing is a marathon, not a sprint.
Well, I'm ready to lace up my shoes and hit the ground running. Thank you so much for guiding me through this fascinating world.
It was my pleasure. Happy investing.
And to all of you listening, thanks for joining us on this deep dive into the stock market. We hope you've learned a lot and feel ready to take control of your financial future. Remember, the stock market isn't just for the experts. It's for anyone willing to learn. So stay curious, keep learning, and happy investing.